Hello everybody, welcome back. And today we are going to be talking about trusts. Very exciting. This is not the type of trust that you have between you and your friend and your best friend. This is a type of trust where you can put properties in to have different tax implications. So let's jump right into it. So there are real estate investors who buy properties, and then there are one who use trusts to pass them down, avoid taxes, and protect their wealth across generations. But here's the thing, not all trusts are created equally, right? Some of these trusts can eliminate capital gains while others can trap them. And we're going to break them down one by one with real-world examples so you can kind of learn how the wealthy truly protect their assets. So I'll do my best with that. So first we have to ask, why even create a trust? One, it avoids probate. What is probate, right? It's a court process that your heirs have to go through in order to get your property after you die. Why does this matter, right? So probate is a process that can take months or even years, especially on some of these larger estates. They can take years to go through. They're public. Anybody can see what you owned, right? And then the third thing is that they cost thousands of dollars in legal fees. With a trust, assets transfer privately, immediately, and without court involvement. The second benefit to a trust is that you can control who gets what and when, right? A trust lets you write the rules. You give your 19-year-old son a monthly income, but not full control until he's 30, right? These are, that's where some of these jokes of like the trust fund kids come from, right? They might be the beneficiary of some amount of monthly income, right? But they don't actually get control of the estate or control of any of these assets until some other conditions are met. It prevents family members from selling inherited property, right? And third, it keeps real estate in the family for generations. If you leave a 10-unit building to your daughter, but the trust says she can only refinance it or sell it after 10 years, right? That would be an example of that. 3, it minimizes taxes. And this is probably the most, the most important reason, right? Some trusts help you avoid or reduce estate taxes entirely. You can also eliminate capital gains through charitable strategies and avoid gift taxes using smart structures like GRATS, G-R-A-T-S, or IDGT, right? And I'll break those down later, so stay around for that. And then another great pro for trusts is that it really protects your assets, right? Trusts can shield you from creditors, lawsuits, divorce, and your own bad decisions even via irrevocable structures, right? So an example of this could be you move property into an irrevocable trust before getting sued, right? That property may now be untouchable in court. Another good reason that I don't hear people talk about that often is that if you become incapacitated and your property is in a trust, your chosen trustee can manage it. There's no need for court intervention, right? If you have a stroke at 65, your son, named in the trust, immediately starts managing your portfolio without needing power of attorney or court approval, which can get really messy. So the bottom line is that a trust isn't just this tax dodge, right? I'm gonna be talking about the tax benefits mostly in the rest of this video, but it's not just a tax dodge. It's a blueprint for what happens to your property, whether you're dead, alive, or somewhere in between. Now, the second definition that we kind of have to get ahead of is estate, right? What do I mean by I say that it takes the property out of your estate? When somebody dies, the IRS adds up the total value of everything they owned to calculate what's called estate taxes. This includes real estate, bank accounts, stocks and other investments, business interests, art, cars, jewelry, etc. This total is called your gross estate. If the value exceeds the federal estate tax exemption, which as of 2025 is $13.61 million per person, the excess is taxed at 40%. Now, 13.6 million is a really big number, but If you have more than that, or if you expect to have more than that in your life, then these are things that you should realistically maybe think about. Out of your estate means not counted towards that estate tax. When a trust removes a property from your estate, it means that legally and for tax purposes, you no longer own the property. So even if you still receive income from it or benefit from it in some way, the IRS can't really touch it, at least in the estate tax sense. The IRS can only tax what you still legally own or control when you die in your name. This essentially allows you to stay under that 13.61 million number, but still have assets that might be valued much, much greater than that, right? So you can see how some of these things are very advantageous, especially to the ultra wealthy. So I'm gonna be breaking down 8 different trusts and their pros and cons. And I'll do my best to explain these, and I'll give a little table at the end of explaining all of them to kind of give you a visual representation of their pros and cons. So, stay till then, right? So let's jump right into it. Revocable living trust. This is like default. This is as basic as you get. There's not many pros to this one, except that you get to avoid probate, which I talked about earlier, right? This is a trust that you create during your life where you still control the property. You can change it, cancel it, add or remove assets. The tax impact of this. You still pay taxes like you would if you owned the property directly. When you die, your heirs get a step-up basis. So they inherit the property at the value of your death, not at the value from when you purchased it. There's no estate tax benefit, but it avoids the probate court, like I mentioned earlier, right? So an example of this, to help visualize maybe, is you buy a duplex in Santa Monica in 1995 for $400,000, right? Today, it's worth $2.5 million. When you pass away, your kids inherit it at $2.5 million, no capital gains, right? So if they were to sell it that day, they wouldn't have to pay any taxes on it. Whereas typically with property, like I said, you buy it for $400,000. If you sell it for $2.5 million, you would have to pay a capital gains tax on that $2.1 million, because that's $2.1 million that you made from the date of purchase. So the step up is really nice if you are looking to sell an asset after death, which brings us into the irrevocable trust, right? This is a permanent trust. You give up control. You can't take the asset back or modify the trust without permission. Who do you need permission from? To make changes to an irrevocable trust, like removing assets, changing beneficiaries, or altering the terms, you typically need the beneficiary's consent. So what does an irrevocable trust do though? It takes property out of your estate. This is important, right? Like we mentioned earlier, which means it helps reduce your estate taxes or put you back under that 13.61 million threshold. But because it's not legally yours, the property does not often receive a step up in basis, right? This is important, and I'll circle back to this in just a moment. And then the trust may have to pay capital gains tax if it sells, which is tied into what I just said. And trusts get taxed at a very high rate. So why would you want to put your property into this? So I live in California, and we have something that's called Prop 13. Now, Proposition 13, which was passed in 1978, is a constitutional amendment that significantly limits property tax rates and reassessment of property values, which means that your property tax is assessed off of the day you purchased it, not reassessed every year, which it is in some other areas. So that's like really, really incredible if you bought a property 20 years ago, 30 years ago, or if you buy a property today in 30 years from now. Prop 13 is really, really nice for irrevocable trusts because, again, this is just my opinion. This is not financial advice, but I personally believe that you should never sell real estate, right? You should always hold on to it for forever, really. But Prop 13 makes irrevocable trusts really, really great because if you never sell your property, your heirs will inherit your property at the tax basis that you paid for it, potentially even before they were alive. So if my parents bought a house for $600,000 20 years ago, and now it's worth $3 million, I would only have to pay the property taxes that were based off of that original $600,000 purchase. Now, this is really, really nice for preservation of wealth, right? Because if I had to do a step up 1% at $3 million, I mean, now I'm paying what, 30 grand a year. And that is a lot. You know, maybe I don't have that, right? Maybe your kids don't have the money to pay for something like that. And this really highlights some of the issues that the ultra wealthy have. If you pass down a $30 million house or a $40 million house or something like that, or real estate portfolio or something, and all of a sudden, all of these taxes get reassessed at this step-up basis, they might be forced to sell because they can't pay those property taxes. So this is why something like an irrevocable trust might be useful. This brings us into number 3, the grantor retained annuity trust. This is a GRAT. What is this? You move a property into a trust and keep receiving income from it for a set number of years. After that, it passes to your heirs, often with minimal or no gift tax. So the tax impact of setting something up like a GRAT is that the property is out of your estate again, so there's no step up in basis. And this is the nice part. Any appreciation beyond the IRS's set rate, called the hurdle rate, transfers tax-free. So the grantor keeps the income, but not the ownership. So you can still benefit from the income that your property makes, even if you're still alive for this trust, right? But you technically don't have ownership, right? The trust does. An example of this would be if an investor puts $5 million into a commercial building into a 10-year GRAT. It appreciates up to $8 million. After 10 years, $3 million in appreciation passes to the children with 0 gift tax, but no step up, right? So the heirs must pay tax on gains if they sell. Number 4, the intentionally defective grantor trust. This is a trust that fails for income tax but succeeds for estate tax, right? You sell property to it, but you still pay income tax, so the trust grows tax-free. The tax impact of a trust like this is that trust assets are, again, out of your estate. Nice, big win. But you keep paying income tax, which means that the trust's value grows faster. No step up in basis unless special provisions are included, often used with installment sales. So the GRAT and the IDGT, these are some more advanced ones. And really the first 2 ones that I mentioned, the revocable and the irrevocable, are gonna be like 80% of the trusts that you see out there. The rest of these are some really higher level things that are used in very specific circumstances to achieve a very specific result. An example of this would be you sell a $4 million apartment building to an IDGT, right? Because this trust technically buys it, right? You sell it to it, in exchange for what's called a promissory note. The trust collects rent, pays you interest, and grows tax-free. So when your kids inherit, they owe capital gains based on your original purchase price, but the estate avoids gift and estate tax. This is number 5, the Qualified Personal Residence Trust, QPRT. This one is a trust that is specifically for your home, right? Qualified Personal Residence Trust. So you live in it for a certain number of years, then it goes to your heirs. Now, this grants you big estate tax discounts based on how long you've lived there, right? If you outlive the term, the property is out of your estate, but there's no step up in basis. So you put your $3 million vacation home into a QPRT with a 10-year term, you keep living in it. After 10 years, it transfers to your kids at a reduced gift tax value, but they inherit your original basis, say $500,000. If they sell, they owe that $2.5 million in capital gains. Kind of like what I mentioned in the irrevocable trust. Number 6, this is the testamentary trust. That was kind of a mouthful. I messed up on that a couple times. But created through your will only after you die, often used to control how minors or heirs get property. Property does get a step-up basis because it transfers at death, subject to probate, but helps manage and control the inheritance. Estate taxes may apply depending on value. So an example of how this works would be your will creates a trust, right, for your daughter when you die. It holds a rental property that gets a step up to market value, the step up basis. The trust pays her rental income every month until she's 30, when she can access the property directly. Number 7, charitable remainder trust, a CRT. So this is a trust where you donate the property to a trust and it gives you or your heirs income for life. And what's left goes to a charity. The tax impact of this is that you get no capital gains tax when the trust sells the property, and you get a charitable deduction, but you lose the step up in basis because the charity ends up owning it, right? So if you were to donate a $6 million property that you bought at $1 million into a CRT, the trust sells it tax-free and pays you income for life. And after you die, the remainder goes to your chosen nonprofit. This is number 8 and the last one. So this is a land trust, AKA a holding trust. This is a trust where a third party holds title to the property on your behalf. This is mostly used for like privacy or ease of transfer, not taxes. So the tax impact is not as important, but I'll run through it anyways. This is often treated like a revocable trust, the first one that we talked about. So it will get a step up or can get a step up in basis. This doesn't help much with estate tax or asset protection, and it's used mostly by landlords and investors. So like if you were to hold a rental in a land trust under an LLC, your name isn't on title, which is really nice for privacy. And when you die, the trust allows easy transfer to the heirs and can get a step up in basis. These are pretty basic. I guess, I don't know what they're called, the little charts that show the yes and no. Oh God, that was a horrible explanation. But I'm gonna put up a little example of how everything works and the pros and cons. And you know, you can screenshot it if this is something that's relevant to you, or yeah, just to help maybe understand it. The trust you choose can either save your family millions or leave them with a nightmare tax bill. The difference is strategy. The point of these trusts aren't to show you these super crazy wacky ways that the rich avoid taxes and stuff. The point is to start to understand the rules and the tools that exist in these tax codes, especially with trusts, so that you know which ones to apply to your situation. There really is no one size fits all with something like this. And this goes for many of the advantages that are in the tax code. Everything is so situational, and it's just important to understand what the rules are so that you can, benefit the most from this. Or I guess your heirs, your kids, or your kids' kids. So yeah, again, this is just my perspective and opinion on these trusts. A lot of this information was really reductive, right? I mean, a lot of this is really, really nuanced. But it allows to maybe do your own research and stuff like that. The ones that I find most interesting are the irrevocable trusts and the GRATs. And the GRAT is a favorite for ultra wealthy families, by the way. So yeah, thanks so much for watching. Let me know down in the comments below which one you guys think is most interesting, or if you know anything about these, or if you know somebody who's used them and stuff like that. I'd love to hear your experience with that. So thanks so much, and I'll see you guys later. See ya.